The balance of power indicator is a powerful technical analysis tool used by traders around the world. The core concept behind the balance of power indicator is measuring the relative strength between buyers and sellers in the market. When buyers are in control, the indicator moves above the zero line, showing buying pressure. Conversely, when sellers dominate, the indicator drops below zero, indicating selling pressure. The balance of power indicator is calculated by taking the difference between closing and opening prices, divided by the range between high and low prices. This formula compares where the price closed relative to its open within the context of the full trading range. On a trading chart, the balance of power indicator typically appears below the price chart as an oscillator. The indicator oscillates around a zero line. Green sections above zero indicate buying pressure, while red sections below zero show selling pressure. Traders interpret positive BOP values as bullish, indicating buyers are in control of the market. Conversely, negative BOP values are bearish, showing sellers have the upper hand. Let's summarize the key points about the balance of power indicator. The BOP indicator measures the strength between buyers and sellers in the market. It oscillates around a zero line, making it easy to identify shifts in market control. Positive values indicate buying pressure, which is generally bullish for price. Negative values show selling pressure, typically bearish for price. Traders use the BOP indicator to confirm trends and identify potential market reversals. The balance of power indicator measures the relationship between closing prices and trading ranges. When prices close higher than they open, the BO value is positive. Let's look at a bullish candle example. When opening and closing prices are equal, the BOP value is zero, indicating balance between buyers and sellers. When prices close lower than they open, the BOP value is negative, indicating selling pressure. The balance of power indicator reflects market strength on a scale typically ranging from -1 to +1. Negative values indicate selling pressure dominating the market. A value of zero suggests equilibrium between buyers and sellers. Positive values show buying pressure is in control. As market conditions change, the BOP indicator moves along this scale, helping traders identify shifts in market control. Let's break down the balance of power formula into its components to understand how it works. The numerator measures the net price change during the period. It's positive in bullish candles and negative in bearish ones. The denominator represents the total trading range for the period. It normalizes the indicator, making values comparable across different securities. By dividing the price change by the trading range, BOP provides a standardized measurement of buying or selling pressure in the market. The balance of power indicator typically appears as a histogram or line below the main price chart. Here we have a price chart above and the BOP indicator below. Let's see how they work together. Values above zero indicate bullish pressure, where buyers are controlling the market. The higher the bars, the stronger this pressure is. Values below zero indicate bearish pressure, where sellers are in control. The lower the bars extend below zero, the stronger the selling pressure. Pay special attention to extreme values and transitions from positive to negative or vice versa. An extreme bullish reading suggests very strong buying pressure. This can indicate a strong uptrend, but also the potential for a reversal if sustained for too long. Similarly, an extreme bearish reading shows very strong selling pressure. This often occurs in downtrends, but can also signal potential upside reversals when sustained. Transitions from negative to positive values often signal potential trend changes. Here, the indicator is showing a shift from bearish to bullish sentiment. The BOP indicator can be displayed as a histogram or as a line. The histogram shows discrete values, while the line form helps identify trends in buying and selling pressure. When reading the BOP indicator, remember these key points. Values above zero show bullish pressure, while values below zero indicate bearish pressure. Extreme values may signal potential reversals, and transitions between positive and negative often precede trend changes. Always use the BOP indicator along with price action for confirmation. The balance of power indicator is a valuable tool for assessing the strength of a market trend. By measuring the relationship between closing prices and the trading range, it helps traders identify whether buyers or sellers are in control. When price is in a strong uptrend, a consistently positive BOP indicator confirms that buyers are in control. This validation of trend strength gives traders confidence to maintain or increase long positions. Similarly, in a strong downtrend, a consistently negative BOP reading confirms that sellers are dominant. This confirmation signals traders to maintain short positions or avoid buying until selling pressure diminishes. When a trend is weak, the BOP indicator provides early warning signs. A price trend with a contradicting or inconsistent BOP reading suggests the trend may lack conviction and could reverse. Notice how the BOP oscillates around zero rather than staying consistently positive or negative. When making trading decisions, the BOP indicator helps assess trend strength and conviction. Consistently positive or negative readings confirm strong trends, while oscillating values suggest caution. This information is crucial for position sizing and determining when to enter or exit trades. Here are some practical tips for using the BOP indicator to assess trend strength. Look for BOP values consistently above or below zero to confirm strong trends. Check if BOP is trending in the same direction as price for trend validation. Be cautious when BOP oscillates around zero during what appears to be a trend. Use BOP strength reading to adjust position size. Stronger trends warrant larger positions. Watch for BOP weakening before price reversal as an early warning sign. To summarize, strong trends show consistent BOP readings, either positive in uptrends or negative in downtrends. Weak trends display BOP values that oscillate around zero, lacking conviction. By using the BOP indicator to validate trend strength, traders can make more confident decisions about entries, exits, and position sizing. In technical analysis, divergence occurs when price movement doesn't match the direction of an indicator. There are two main types of divergences we can spot with the BOP indicator: bearish divergence and bullish divergence. Bearish divergence occurs when price makes higher highs, but the BOP indicator makes lower highs. Notice how the price continues to climb, making a higher high, while the BOP indicator fails to confirm this move, creating a lower high instead. This divergence indicates weakening buying pressure despite rising prices, and often signals a potential downward reversal. After this bearish divergence, we often see a price reversal to the downside as the weakening momentum plays out. Bullish divergence occurs when price makes lower lows, but the BOP indicator makes higher lows. Here, the price continues to decline, making a lower low, while the BOP indicator shows improving strength with a higher low. This divergence suggests decreasing selling pressure despite falling prices, and often signals a potential upward reversal. After this bullish divergence, we typically see a price reversal to the upside as the improving momentum translates into price action. Here are some tips for effectively spotting and trading divergences with the BOP indicator. Look for significant swings in both price and the BOP indicator to identify meaningful divergences. Always confirm divergence signals with other indicators or price action patterns. More pronounced divergences, where the difference between price and indicator direction is clearly visible, tend to be more reliable. Be patient and wait for price to begin confirming the reversal before taking action. Higher timeframes, such as daily or weekly charts, often show more significant divergences that can lead to major trend reversals. To summarize what we've learned about divergences with the BOP indicator, divergences are powerful signals that can help you identify potential trend reversals before they happen, giving you an edge in your trading decisions. The balance of power indicator becomes significantly more effective when combined with other technical analysis tools. Before exploring specific combinations, let's understand why using multiple indicators improves trading results. Using multiple indicators provides several advantages. They confirm signals from different perspectives, reduce false positives, offer diverse market insights, and create more robust trading systems. Let's start with combining the balance of power indicator with trend indicators, particularly moving averages. Here we have a price chart with a moving average overlaid in green. Below is the BOP indicator, showing positive values in green and negative values in red. When combining BOP with moving averages, we look for confirming signals from both indicators. Use BOP to confirm the trend direction shown by the moving average. A strong entry signal occurs when price crosses above the moving average, while BOP shows positive values, indicating buying pressure. Consider exiting when BOP turns negative, showing selling pressure, even if price remains above the moving average. Now let's examine how balance of power can be combined with momentum indicators like the Relative Strength Index or RSI. In this example, we have a price chart showing a downtrend. Below it is the RSI indicator with overbought and oversold levels at 70 and 30. At the bottom is our BOP indicator. The most powerful strategy with RSI and BOP is to look for oversold conditions in RSI, suggesting a potential reversal. Then confirm this signal with the BOP turning positive, indicating that buying pressure is returning to the market. When both indicators align, they provide a stronger signal than either one alone. In this example, RSI moves up from oversold territory, while BOP turns positive, generating a buy signal. One of the most powerful applications of combining indicators is confirming divergences, where price and indicators move in opposite directions. By using multiple indicators together, you can significantly increase your trading signal reliability. Start by identifying a BOP divergence, which suggests a potential market reversal. Then, look for RSI confirmation, which increases the probability of a successful trade. Moving average crossovers can help time your entry, while volume spikes provide additional validation of the reversal. This approach dramatically improves success rates compared to using indicators in isolation. As shown in this comparison, using 3 or more indicators in combination can more than double your success rate versus relying on a single indicator. The balance of power indicator comes with default settings on most trading platforms. By default, the BOP indicator typically uses a period of 14 bars and doesn't apply any smoothing. Traders can adjust the period setting of the BOP indicator to suit different market conditions and trading styles. A shorter period, like 5, makes the indicator more responsive to recent price changes, but also more volatile with more potential false signals. The default period of 14 provides a balance between responsiveness and reliability. A longer period, like 30, creates a smoother line with fewer false signals, but it may be slower to respond to new price developments. To reduce noise and make the BOP indicator easier to interpret, traders often apply various smoothing methods. Here we can see a comparison between a raw B indicator and one with a simple moving average applied. Different trading styles require different BOP settings for optimal performance. Day traders working with short time frames should use shorter periods between 5 and 8 to capture quick market movements. Swing traders typically benefit from medium periods between 10 and 14, which provide a good balance between signal quality and timeliness. Position traders using daily or weekly charts should consider longer periods between 20 and 30 to filter out market noise. Remember to always backtest your BOP settings before using them in live trading conditions. The first common mistake traders make is relying too heavily on the balance of power indicator alone. When traders use BOP as their sole decision-making tool, they often miss important signals from other technical indicators and fundamental factors. To avoid this mistake, always use BOP as part of a comprehensive trading strategy that incorporates multiple indicators and analysis techniques. The second major mistake is ignoring the broader market context when interpreting BOP signals. BOP signals can be misleading if you don't consider overall market trends, sector performance, and relevant news events. Always check the broader market conditions before making trading decisions based on BOP signals. This context is crucial for accurate interpretation. The third mistake is misinterpreting BOP signals during periods of low volatility. In sideways or consolidating markets, BOP can generate numerous false signals that lead to unsuccessful trades. During low volatility periods, consider using additional volatility indicators like average true range to filter BOP signals, or simply avoid trading during these consolidation phases. The fourth common mistake is taking BOP signals that contradict the established market trend. Even strong BOP signals can fail when they go against the primary trend of the market. Always identify the primary trend first, then only take BOP signals that align with this trend for higher probability trades. The fifth mistake is using inappropriate BOP settings or timeframes for your specific trading strategy. Different trading styles require different BOP parameter settings and timeframe selections. The key to successful BOP trading is using it as part of a comprehensive approach. Combine it with other indicators and always consider the market context. Remember these key points to avoid common BOP indicator mistakes. Never rely solely on BOP. Consider market context. Be cautious during low volatility, trade with the trend, and use appropriate settings. Let's examine a practical trading strategy using the balance of power indicator. This strategy combines the BOP indicator with trend identification and momentum confirmation to identify high-probability trades. First, let's review the entry rules for this strategy. For long entries, we look for the BOP to cross above the zero line with price near support levels and RSI showing oversold conditions. Now, let's examine our exit rules for proper trade management. We'll take profit at predefined price targets with a minimum 1-to-2 risk-reward ratio and place stop losses below recent lows for long trades. Risk management is crucial for long-term trading success. Here are our guidelines. We'll risk no more than 1-to 2% of our trading capital per trade, with position sizing based on the stop-loss distance. Now let's examine a real-world example of this strategy in action. Here we have a 4-hour chart of EUR/USD with price action, the BOP indicator, and the RSI for confirmation. Notice how the BOP crosses the zero line at bar 7, signaling a potential bullish reversal. This happens as price forms a base near support. Looking at our RSI, we can see it was previously in the oversold region below 30, confirming our bullish bias. With our entry signals confirmed, we enter a long position at the close of bar 7. We place our stop loss below the recent low, which provides a clear invalidation point for our trade idea. Our target is set at a 1-to-2 risk-reward ratio, giving us a favorable profit potential relative to our risk. Now let's calculate our position size based on our risk management rules. With a $10,000 account and risking 1% per trade, we're willing to risk $100 on this trade. Given our stop-loss distance and pip value, we calculate a position size of 0.1 lots. Let's look at the outcome of our trade. In this example, price reached our target level, giving us a profit of 44 pips, or $44 per 0.1 lot. Our stop-loss was never triggered. To summarize the key elements of this BOP trading strategy, we enter based on BOP crossing the zero line with RSI confirmation, place stops below recent lows, set targets at minimum 1-to-2 risk-reward, size positions based on our risk tolerance, and look for additional confirmation from support and resistance levels.